Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, we're still in the same coronavirus-induced setup, working from home, so the backdrop once again looks very different. But in terms of markets, we have hit a period since the last time I did this show of seeming stability. So the market's volatility has started to feel a little bit less severe than it had done, say, last week. But does that mean we're out of the woods? The answer to that is more than likely no, because as I look at this now, then we are seeing a market that's up today. So today is Thursday. I mean, the S&P 500 is back above 2,500, which is obviously a good sign. We're seeing the Nasdaq up about 1.4% today. The FTSE's up about 1.3% to 5525. It starts to make people feel that we're in a very positive upward trajectory. And I mean, in fact, if you look at what happened last week, equity markets had rallied from the low that was on Monday. So we actually got to the point where we had the Dow Jones rally over 20% in a matter of days. And of course, that led to headlines saying it was the shortest ever bear market and we entered a new bull market, because don't forget that a bull market is defined as a 20% rally from a recent low. But that's all arbitrary. It's really just labels that for some reason we're obsessed with putting onto markets. But of course, as I mentioned last week, bear market rallies are quite dangerous and they're very common. The strongest rallies in equity markets are usually always found in bear markets. And the danger is that those trends can reverse. Now, although we've seen the equity market seeming to bounce up and down, if you take the S&P 500, for example, we've been sort of bouncing around in the last few days between 2,450 and up towards 2,600 and above. So that level we've been bouncing up and down between the two. Now, if we are going to see some sort of capitulation again, then what we're likely to see is the S&P 500 break below that 2,450, so 2,450 level. If we do, then there's a very good chance that the technical signs, when you look at the analysis, would mean we might visit that low that we had recently, head down towards 2,200. Of course, there's no reason why we would always necessarily stop there. It's nothing to say we'll go lower, but past markets have shown that it is a possibility. And do bear in mind, when we went back to 2008, we have a lot of people who say, well, the markets rebounded at the beginning of 2009 when the Fed turned around and started to be more accommodative. But if you look at 2008, you could argue we hit a low after the sort of October period, and then we rallied and then we retested that low and broke through, in where we ended up on December, in fact Christmas Eve 2008. So just because you end up retesting the low doesn't mean you can't go below it. So it's something to bear in mind. I mean, one of the things that would be interesting to keep an eye on is the VIX. I keep mentioning the VIX, the VIX, in these videos. And at the moment, as I'm looking at this, it's near 54. So it's pulled back a bit, but it's still very high. And that sort of level does mean that we can expect still high levels of volatility going forward and swings intraday in the prices of equity markets, or in this case S&P 500. Of course, what the S&P tends to do and US stock markets tend to do, the rest of the world does tend to follow. So we can expect more of what we've seen probably in the past in terms of volatility. In terms of the bond markets, now they've been quite interesting, because what we've seen is the volatility in US Treasury start to pull back. So it started to reduce, which would mean that it's making Treasuries once again more investable. So they're starting to behave more like we would expect them to, rather than just being correlated to equity markets as they did when we had the peak of the sell-off in the last week or two. That doesn't mean it can't change course, but on the face of it, it looks like central banks' policies, so that include particularly the Fed, printing more money, keeping interest rates low, but particularly printing money, buying treasuries, entering that bond market, is starting to stabilise things. And if the bond market continues to stabilise, that can only be good news for equity markets. But then, sticking with the bond market for the time being, we've started to see treasury yields fall again. And that's largely because of the economic data we're starting to see. Today, for example, in the US, we saw there was another 6 million US jobs claims, which if you combine it to what we had last week, that takes it to 10 million people. That's an incredible number. And if that's the case, and we see this trend continue, we've probably already beaten what we saw in the financial crisis. So the economic reality, there's an argument that maybe the stock market hasn't quite priced all of that in or is overly optimistic. And the bond market is now once again being much more perhaps pessimistic, realistic, and therefore people are starting to buy back into bonds like they did in a normal behaving market. And so what we're seeing is bonds actually start to strengthen a bit, even though equity markets are still strengthening. But we're starting to see people buy bonds, and in particularly we're seeing US treasuries do well. But what is interesting, if you look at your portfolios, you will have noticed this. In fact, you will have started to notice your corporate bond funds starting to do a bit better, doing what they should do really, which is diversify your portfolio. So if we have a day where equity markets tumble, then your corporate bond funds were starting to provide some sort of positive trade-off. So basically something that can actually diversify. So they're actually limiting the downside in a way. So that's what a diversified portfolio should do. And the good news is we've started to see more of that in the last week or so. Things behaving more like you think they might do. But having said all that, like I said, we're getting mixed messages from the market. So the price of gold is going up. Bonds are obviously rallying, so which means that their yields are falling. But at the same time, equity markets are still more bullish than they were a week or so ago. So it does tend to suggest that maybe we're back in that position again we were before this sell-off, where bond markets are saying one thing and equity markets are saying the other, and bond markets ended up being proved right. We won't know until this all plays out. One thing that is also interesting is that defensive sectors, so that was utilities in particular, they performed very strongly in the rally that we had last week. And if you have a market rally, so you have all the different sectors, you have cyclical sectors, you have things like technology, or you have financials, a good example of a cyclical sector. So sectors that are sensitive to the economic cycle, then they didn't perform as well last week. So what we saw is defensive sectors start to do well. REITs did quite well. As I said, utilities did well. Consumer staples did well. And what you want to see in a rally that will be sustainable, you want to see other sectors, financials in particular, rallying and helping to drive things forward, not just being the defensive, because it may ultimately show that the rally is particularly weak. People are actually buying things that they think will offer them a bit more protection if equity markets roll over. Although in the latest sell-off, utilities, REITs, some of the defensive have still tumbled along with everything else. Interesting when you look at your portfolios as well is absolute return funds have been disappointing across the board. There's only been about a handful, say four or five absolute or targeted return funds, as they're called now, that managed to produce a positive return during this period, this sell-off that started in February. Now, the way they're often marketed is that these things are meant to be able to produce a positive return in most market conditions. Even if it's not most market conditions, you'd expect them to do it in a negative market, because that's obviously where they should come to the fore. Unfortunately, they haven't, and that's perhaps not surprising, because often marketing is slightly misleading. I mean, I've done a piece for 80/20 investor members where I'm looking at almost like a coronavirus portfolio. It's looking at funds that have done well in this particular sell-off. And the ones that have done particularly well are UK gilts, understandably. I mean, I recently published our perfect ISA portfolio, and gilts are a key part of it. We've seen a couple of absolute return funds do relatively well, but funds that are exposed to US treasuries have done well, but also that are exposed to the upside in US dollars. Because don't forget, the US dollar has been the asset of choice, the haven asset in this sell-off. And it also explains why, well, we've had this optimism in the last week or so that the pound has started rallying against the dollar. We're up at $1.23 at the moment as I look at it, which has come some way since about $1.16 that the pound was trading at about a week or two ago. And that's because the dollar has fallen. As people are becoming a little bit more confident, then they are moving out of dollars into other assets. So we are not out of the woods quite yet, but in fact by any stretch. There's a lot that's still got to play out in the coming days and weeks. But one thing that's quite interesting as well when you look at investments is there are a lot of people trying to predict what will do well in this environment. And I don't like to keep using the word unprecedented, but because of the scale of the closures that we've had globally, whole economies being locked down, the old ideas of what would do well in a recession or in a market that is pricing in a weaker future growth aren't really holding true at the moment, because we are in a world that we've never been in before, so we don't quite know what's going to happen. And we've seen an example of that in recent days when pressure was put on banks to cut dividend payments, because obviously the Bank of England wants them to lend money, any money that they're receiving, so they don't want that money going to shareholders, and they want the banks to be able to push this liquidity onwards and actually help the economy. And so what you saw with bank stocks do very badly this week, and it also means that for income investors, they will see some of their dividends cut if they're relying on those dividends from shares directly or via certain equity income funds. And what it means is that in these times that are unprecedented, you don't necessarily know where the next landmine is. So it could be in property, it could be where commercial property and companies are unable to pay their commercial landlords. We just don't know where it will be yet. So there's going to be a lot of landmines that we're going to have to navigate through all of this, and they're popping up like the bank dividends. So that is something to be mindful of, but there's very little you can do to avoid it unless, of course, investors are in cash. And don't forget, cash is a position after all in a portfolio. That doesn't mean it should go out and necessarily cash in your investments. I'm just saying that cash is an asset class, and I know there are plenty of people who have sat on the sidelines throughout this sell-off. So that is it for this week on Midweek Markets. As ever, you can email me, Damien@moneytothemasses.com is the email address. Twitter, moneytothemasses with the number 2, and of course via all our social channels. So don't forget to join our Facebook group, facebook.com/groups/money to the masses. You can ask questions in there about anything, not just investing. And of course, do not forget to subscribe to our YouTube channel.